Assalamualaikum and a very good day I bid to Dr. Haslinda Ibrahim, our respected accounting and finance lecturer. Our group, which is Group 28, will present our financial ratio analysis for the company Seng Industries Berhad and Huatai Industries Berhad for the year 2016 until 2020. I am Chusna Maria, the leader of the group, and before I begin further with our presentation, I would like to introduce my group members, the ones that you will be seeing in the rest of the video, which are Muhammad Hafizi, Wang Zanzan, Muhammad Amirul Khairi, Muhammad Fakhri Azam, Wan Nur Alia Naili, Muhammad Irfan Harith, Muhammad Haziq Wajdi, Nur Shahira, dan Ku Muhammad Zafri.
Hello, my name is Wang Zhenzhen. I will analyze the various proportion of this company. The current ratio showed a downward trend from 2016 to 2020 from 3.04 to 1.8. The S-tester ATO showed a downward trend from 2016 to 2020. The inventory turnover increased from 2016 to 2019 and then declined in 2020 but generally showed an upward trend. The accounts receivable turnover decreased from 6.84 to 4.6 from 2017 to 2018. It fell 2.24 but rose from 4.6 to 6.59 from 2017 to 2020. From 2016 to 2020, assets turnover increased from 0.69 to 0.97 year by year, showing an overall upward trend. The debt to assets ratio increased from 0.25 to 0.39 year by year from 2016 to 2020, showing an overall upward trend. The debt to equity ratio increased from 0.74 to 0.64 year by year from 2016 to 2020. Times interest rose from 2.34 to 2.86 from 2019 to 2020. Net profit margin jumped from 17 to 3 to 12.3 year by year from 2016 to 2020. Return on assets declined from 0.021 to 0.176 from 2016 to 2020. Returns on equity increased from 0.269 to 0.288 from 2016 to 2020. Earnings per share declined from 0.062 to 0.05 from 2016 to 2020. The price-earnings ratio rose from 18.87 to 19.46 from 2016 to 2019 to 2020, but rose from 17.5 to 19 from 2019 to 2020.
Alright, we're going to look at the trend analysis of another company known as Huatai Industries Berhad, a company that specializes in manufacturing biscuits and cookies. From 2016 to 2017, the current ratio, asset tax ratio, have a slight increase, but then it slightly decreased from 2018 to 2020. In 2016-2020, the assets turnover has an increase. The inventory turnover has a significant increase until 2017, but then it dropped in 2019 and increased in 2020. The accounts receivable turnover increased from 2016 to 2018, but then it dropped in 2019, but later increased in 2020. Both the debt assets ratio and debt equity ratio has a slight increase all the way from 2016 to 2020. The times interest earned increased drastically 2 years, but then it dropped more until 2020. The net profit margin, however, decreased from 2016 to 2018, but then it rose back up until 2020. The price earnings ratio also has a major decrease for 2 years, until it managed to rise back up in 2020. The returns on assets, equity, and the earnings per share skyrocketed until 2018. However, it also experienced a major drop until 2020.
Hello again. So, based on the ratio analysis, which company appears to be a stronger candidate financially? To answer this question, I will be comparing both the company Seng Industries Berhad and Huatai Industries Berhad based on four categories of ratios. The first one is the liquidity ratio. Liquidity ratios are sometimes called working capital ratios because that in essence is what they measure. The liquidity ratios are the current ratio and the quick ratio. Based on the bar chart, we can see that Seng Industry has a higher current and quick ratio than Huatai Industries. It is proven that Seng Industries has a higher liquidity ratio, which shows the company is more liquid and has a better coverage of outstanding debts. Move on to the second ratio, which is the efficiency ratios that measures a company's short-term ability to turn current assets into income. For this ratio, we will look at the inventory turnover, accounts receivable turnover, and asset turnover ratio. Once again, we can see that Seng Industries has a higher ratio for all efficiency ratios than Huatai Industries. This proved that Seng Industries is efficient at producing sales from assets, efficient revenue collection, and selling goods quickly, and there is considerable demand for their products than Huatai Industries. Let us move to the third ratio, which is the profitability ratios. It is one of the key metrics to use when monitoring a business overall financial efficiency and health. For this ratio category, we will look at returns on assets and returns on equity ratios. It is still the same result as the other ratios that we see. Seng Industry has a higher ratio than Huatai Industries, but the difference is that we can see a significant difference between the ratio for both companies. This result shows how well Seng Industries use investments and its total assets to generate profits and can be increased through economies of scale compared to Huatai Industries. And we have come to the last category, which is solvency ratios, which are the debt to equity ratio and debt to asset ratios. Solvency ratios measures a company's ability to pay off its debt obligation without diminishing its shareholders' equity. In contrast to the other ratios, we can see that Huatai Industries has a higher ratio compared to Seng Industries. Ideally, a debt to equity ratio should be less than 1. A higher ratio indicates that Huatai Industries is carrying dangerous amount of debt, while a higher debt to asset ratio means that Huatai Industries has borrowed more money than its assets indicate it is worth compared to Seng Industries. So, seeing all the ratios and comparing both the company, we as a team have concluded that Seng Industries Berhad appears to be a stronger candidate financially than Huatai Industries Berhad.
The company business is one of the factors that our group take into consideration in making the investment decision in both companies. Seng derives income from two main businesses. First one is biscuit manufacturing. Chap Ping Pong and Seng cream cracker are popular among the low to middle income group of customers. Coke and Natural are the premium products of Seng, which are targeted to higher income group of customers. Second, beverage manufacturing. Seng acquired in comics food industry. It is involved in manufacturing coffee mix and beverage under brands such in comics. Huatai derives income from biscuit manufacturing. The company's biscuits are marketed under the brand name of Huatai, Grocery, Farmers and Festa. Its products include cracker, cookies, cakes, luxury, cream sandwich and assorted biscuits. From this business in 2016 to 2020, we know that Seng and Huatai shows growth in total revenue. The businesses remains as the main income contributor to Seng and Huatai.
Thank you, Shahira, for the explanation. I'm Alia, and I will explain another thing that our group would take into consideration before making investment decision. I would take balance sheet into consideration before making investment decision. This is because based on the balance sheet, we can examine the resources and debt of the company as it will report the company's assets, liabilities and shareholders' equities at particular points of time. It's very important to take balance sheet as consideration before making an investment, as we can see the company's performance and net worth. A great performance and increasing net worth will be a great reason for the investor to invest to the company. Other than that, we can calculate the fixed asset turnover ratio by dividing the net sales by their average fixed assets, so that we can see how much revenue that the company gained from its assets and whether the assets are managed efficiently. We can also calculate its current ratio, which will measure the financial risk of the investment. So, based on all the reasons, I think balance sheet is a great factor to be considered before making an investment. I think that's all from me, and I will pass to my friend Fizi.
Hi, thank Alia for the presentation. Before I started for the last part of question 3, my name is Muhammad Hafizi bin Azmi, nomometric 153385. Beside historical financial performance, what are the statement or report that we can use? We can also use cash flow of the company as consideration in making decision to invest. In everything that we do, there must be a reason, right? So there must be a reason for why I suggest you to check the cash flow before making the decision to invest. There are 3 reasons that I can give you here for why we must look at the cash flow before investing. The first reason is the cash flow represents the inflows and outflows of the company. It shows about how the company is spending their money and where the money came from. And the second reason is cash flow. By look at the cash flow, we can see the liquidity of the company. What is the liquidity of the company? It shows the change of money over period. So if the company have been established for about 3 years, we can see the liquidity of the family. We can see how the money changes from over time. And we can see how active the company. And lastly, it can also determine the short-term viability of a company. So the last reason is the bottom line. In the cash flow, we have to see the bottom line. It is the most important thing to check in the cash flow. Because of why? Because bottom line reports it shows the overall change in the company's cash and its equivalent, the asset that can be immediately converted into cash over the last period. And it shows whether the company available to pay the bills by the cash. So it is important. So this is the summary about why we should look the cash flow before investing in some company. Because cash flow is indeed important for the investors to look, as it is representing the inflows and outflows of the company, about how active the company and how it changes over a period. Because no matter how profitable the company is, if it lacks the capability to pay bills, it is likely to fail. So the investor that investing in company should be aware of the cash flow, whether it's negative or positive value. Positive cash flow is a good choice, it's a wise choice for the investors. But we have to remember, because negative cash flow doesn't mean that you have to be rejected it directly, because as it may show the improvement later. So that's all from me, thank you.
Seng, future prospect of Seng. Seng is one of the leading cracker or biscuit manufacturer in Malaysia, and the company was affected during the first MCO. Even though the company suffered in the financial year of 2019, the first movement control audit issued, the group has managed to generate about around 327 million in revenue, which was increase of 5.7% from financial year 2019 revenues. This will continue to rise as MCO have been lifted completely. The company have developed several future prospects to help the environment while producing biscuits. The future prospects are as follows: sustainability. As you already know, right now we have a climate changing issue. So the company has introduced ways to reduce energy consumption and environmental compliance on factories. The group also plans to develop new healthy food by using new healthier ingredients. The company also will increase export after the MCO, as MCO has been lifted completely.
My name is Muhammad Irfan Hari and I will present about future prospect of Seng company. The first one, 2021 will be another challenging and uncertain year for the global economy, as the global economy faces renewed commodity shortage as a result of factors such as the rapid spread of COVID-19 outbreak and supply chain disruption. Next, rising energy costs, supply chain disruption, labour and climate change. The global economy is at risk of renewed commodity shortage. The group's greatest challenge will be rising material costs, and managing costs will be a long-term priority for the group. The company confident to overcome global container shortage, port congestion and soaring shipping rates for their product. Lastly, they will continue to explore new market to broaden its revenue and enhance their competitiveness of the product. That's all from me. Thank you.
So, which company that our group recommend? Our group has chosen to recommend Seng Industry Berhad for some reason. One of the reason is Seng Industry Berhad is financially better than Huatai Industry Berhad. We can see from the bar chart which represent the current ratio for both companies. Since 2016, Seng Industry Berhad have a better ratio compared to Huatai Industry Berhad. We can see the other years too, like 2017, 2018, 2019 and 2020. Seng Industry Berhad current ratio are bigger. Even though the ratio keep decreasing by years, Huatai Industry Berhad always have a smaller ratio than Seng Industry Berhad.
Profitability is a simple term for a company total income exceed its total expenses for any given period. Net income or a net profit is also known as other name for the profitability. Based on our observation, Seng company total revenue in 2021 was 295 million. The gross profit might affect as MCO occur in our country. The total gross profit for 2021 was 81.67 million. We choose Seng company as it is a well-known biscuit manufacturing in Malaysia. It also has a large amount of revenue and it is expected to make more in year 2022 on the second half of the year.